Hi. Amy Spees, I'm in the finance department, and we're going to talk a little bit about the financials today, the P&L. I'm going to go over like a big global view and then some like best practices and give you little hints of what to look like and what to look at. I'm sure you have a whole myriad of expertise, and some people might know some numbers, some people might know nothing about numbers. So I'm going to, in layman's terms, break it down and pretend like you know nothing. You can ask questions along. I have some charts. Gary and Sophia's going to jump in, along the way. So feel free to stop me anytime you need to. So we're going to kind of go over the financial reports, what a profit and loss statement is, a balance sheet, and what I call the month-to-date, year-to-date percent of revenue. And on those different reports, there's key things to look for. You don't have to memorize it all. You don't have to do it all and know exactly where everything is. We're going to talk about coding, accounts payable, why it's important, third-party vendors, benchmarking, best practices, and a couple other things. So for the reports here, the profit and loss is a tool to help manage your business. It gives you feedback. It shows what you're doing. There's the trend. If you put in so many months that you're open with, you can look to see if there's highs, lows. You want to see where you are at any given point. Prepaids and accruals, I like to streamline things out. It's important because say you're doing a $2,000 marketing expense or campaign it's going to last a whole year. Like, you can just hit it where it hits, a bucket of $2,000 that month, or you can spread it out. You do like a journal entry and just break it down, divided by 12. That way it's more consistent. You know what the trend is going to be. And then the same thing for payroll as well. You get paid every 2 weeks. So it's always a 14-day, 2 times a month. If you just let it hit when it hits in that month, then you're going to have 2 times a year, 3 payrolls hit in a month. So what I like to do is accrue for those extra couple days of the month. So it kind of, again, streamlines everything. It tells a story that you're okay with staffing and patterns, and otherwise if you hit, it's up, it's down, you're not sure what you're doing, and you don't know how to control your costs. So those are the high-end things with the journal entries. Your accounting person can help you out with those. So the actual profit and loss statement, this is the one that we do the month and year to date on it, and it's not every single thing on our chart of accounts. I squished it down so you can really kind of see it a little bit better. And pointing out a couple things here. We have at the top the revenue with the product categories are food. We combine the hot and cold beverages, the bottled beverages, and the retail. And then we have the cost of goods sold that corresponds to each level as well. And that way, on this kind of report, you can really try to see, here's our cost of goods sold. The goal that we try to, our benchmark number that we want to look for is about 25%.
We are going to be sending the slides out, so if you're not able to quite see it, or if it's a little too small or too much information to write down, all of the presentations we will be getting to you guys as well.
The crew was ready to leave.
That's helpful.
Yeah. So these are all things, and you can always, call me and see if you want to go through this, if you have any specific questions. Again, you also have the other big piece of your expense line is obviously your wages. So that will be on there. And again, whether you have a manager or not, you want to be in the range of like 25 to 30% for your staff. And that does not include the taxes. Obviously a little higher if you have your on-staff manager included. So that's the big piece of it. And then you'll have other categories like your rent, your insurances. And here you went straight to the bottom line. And this shows like a 15% net profit margin, which is here. To provide a service and everything, but also make a little bit of money, which is a good thing.
We spent a little bit of time during the last breakout with cost of goods sold, right, Abe?
Yeah.
There was some various ways to calculate them. So just by show of hands, as an operating store, how many are doing a monthly inventory? Count every month, every month. And when you do that monthly inventory, how many are making an adjustment to their P&L to get it on an accrual basis, or are they just doing it on a cash basis? Okay. Sort of like this list. Who's accrual? Who's cash? Okay, so we have some differences. And again, it's really your choice on how to do it, right? My recommendation would be to do the accrual method throughout the year, and then at the end of the year with your tax accountant, get it more to a cash basis so you can take advantage of your tax situation. If you just do it on a cash basis, sometimes you're going to get fluctuations throughout the month, and it's not really going to be reflective of those true sales because of the way the timing of invoices hit. So if you do that, if you do the accrual method where you're making that adjustment at month end to truly reflect the usage of the month, and the theory is whatever's left in your, that you're counting, you're going to be using for future months, so you shouldn't expense that this month. I think that these percentages start to make a lot more sense. If not, you could have certain months where you might not have done a lot of buying, but that's not truly reflective of your cost of sold for the product that went out the door. So my recommendation would be to try to do the inventory, adjust for it with an accounting entry at the end of each month. And I think that way you'll be able to use then these percentages to help run your business a lot better. The other thing is, how many people get their financial statements either doing in-house or from their accountant by the 10th of the month? How many get them by the 15th of the month? How many get them by the 20th? 25th? 30th? I mean, for our complexity of business, I will tell you that I would be challenging each of your accountants, and I don't know what you pay them. You should be getting it by the 10th or 15th of the month. If you get it by the 30th of the month, by that time, if you're making any business decisions on it, I mean, the war's over. I mean, you need to use that as a tool to manage your business, and to get that far past, I think that account's not doing you any help to help you run your business, because the story's old then, right? You're just then getting it, you're filing it, like, how did this come out? So I would really start to challenge whatever accounting firm you're using, that you need this information on a timely basis to really help you run your business and tell the story, you know, good or bad, of really what's happening. If you're not an accountant, force yourself to learn your numbers. I know it might not be something where your comfort zone is, and if it's not, we can help you. Amy's very comfortable with walking through these P&Ls. Your regional should be your first level of support to help you on these P&Ls if you're not understanding them. So please don't shy away from it. I mean, the information, if you take the time, we'll go through some steps to really, you'll get out of the financial statement the accuracy you put into it. So if you're sloppy with stuff going into it, it's going to be a sloppy story coming out. So.
And the other piece to tip on with the whole inventory count, so when you here's your revenue, which is based on the POS session summary. If you just let your cash hit the cost of the food, the beverage, whatever, this might not be real. Like if you have a huge order at the end of the month, a $2,000 order, and you just let it hit there, you know you're not using it all until, you know, maybe a couple days, but mostly into the next month. So then that again, you won't be able to see if these numbers are right because it's just hitting where it's hitting and not where the true cost is used. So, do you want to comment? Moving on to the balance sheet, so it's pretty much assets, liabilities, and equity. Assets are everything, the cash, the inventory, your franchise fee, your whole lease improvement category, which everything kind of gets rolled in there with everything you put to begin, like your pre-opening costs. Liabilities are maintained from your accounts payable, anything accrued, your sales tax liability, any other loans, SBA loans, long-term notes, whatever. And then equity is what you as an owner has put in, or net returns, your owner's draws, and then the difference of that, you know, you have your net income and retained earnings. So you don't need to memorize that, but this is how it shows out on the balance sheet.
Much better.
Huh? Now you can see it. So again, up top here will be like all your assets, the inventory count at the end of the month. This is just a sample, it's 10,000. There's a prepaid, again, if you have your insurance bill that you know you're paying $2,000 now, but it's really a quarterly bill. So I like to book, you know, part of it here, spread it over 3 months. The suspense or deposit in transits, you know, like even the months coming, the cash, the timing, when the actual credit card sales come through. So that's always a big number. It's a little fluctual number, and eventually it'll zero out, but you never know what the timing is. Fixed assets, again, your leasehold improvements, your furniture, movable equipment, other assets, your franchise fees, down into liabilities, any loans, and then the net there is the net income, less return of earnings. So Again, we kind of touched on this a little bit for accounts payable. It's really important to get those coded in the right buckets, so you do, again, know how to control your cost of goods sold. With Cisco, we're working with them now to better align their bills, so we put them in the right orders. Before they had their own subcategories, I know people were entering them. It was really hard and confusing because they just had dairy, and then they had, which include ice cream, but also milk or the creamers. So we asked them to go back and put everything according to our chart of accounts and general ledger. So it'll be a little bit easier. They promised that by, I think, the 3rd week of October. So we're going to try to get them to commit to that. And that way it'll be just hopefully the 4 categories: our food, our hot, cold beverages, obviously Cisco's not the bottled, and then like retail. But including in that, if you get like the cups and the lids should be factored into the hot, cold beverages. Before some people would put that into paper. Because when we're doing the costs of that, the same thing with the donuts, like the boxes are actually part of the food cost, because that's how we had priced it all out. So I guess in the paper packs, then would just be like your napkins, your non-product use, your stirs and everything. We touched about the inventory versus expense. Again, doing the whole trending and making sure things are in the correct time frame will also help you in the future, and doing forecasts and budgets. So you know where you came from, you know what to expect. Let's put this in and then see what our sales could be, and that way we can have a good budget for next year.
The most important thing there too, Aim, right, is to be consistent, right? If you're gonna code an advertising expense one way this year, code it the same way next year. Or else your comparisons are gonna be way out of whack. If you decide to code cleaning supplies to one account, code it to the same account every time, or else you're gonna be like, what the heck's my own numbers? And then it really won't mean anything to you. So if you're just starting out, be disciplined in the beginning, be consistent in the beginning, and then everything will be, you'll be able to then really have good comparable data from month to month.
Okay, so third-party vendors, we've connected with QuickBooks Online, and we have a rate of $18.90 now a month. So make sure if you had already purchased that we can contact Ryan and they'll set your amount to there. Some people use ADP, not everybody does, but we do have a direct contact with them. And then if you don't have a bookkeeper, again, my side business, I do the back end bookkeeping office stuff, so you can contact me directly if you need help for that. We're hoping to streamline a lot of things, so even with QuickBooks Online, we keep hoping to get everything to merge into that. I know they merges with bank accounts, automatically feeds right in, hoping to get Cisco eventually on that. Some payroll things do come through, so making it easier was that's the goal. And why did we ask for the P&L? Again, it's for a tool that you can help manage your business, like recording the numbers, how it's like a report card, and that way you can look at it and find out where you need to improve, what's going on. It tells a story. Now we decided that Gary had started putting things together, a scorecard and comparisons based on history that we now have in the company for the past couple of years. So he's going to tell you about the next couple of things.
So, we don't ask for the P&L. We said this time and time again to really monitor what you're making. What you're making is your business. But if you're having a problem, that's our business, right? Because then we want to be there to help you. And the only way we can help you is to get your information, compare it to other operating units we have, look at our benchmarks, keep evaluating our benchmarks, and see where are we trending. So Russ and I have been working on really coming up with a system to try to determine the health of a franchise. Right? Which franchisees should we put our effort in, whether it's financial or non-financial, and which ones seem to be healthy. And we've come up with some categories right now. Half of them are financial-driven categories: your weekly sales, your monthly sales, what you're operating as a cost of goods sold percentage, what you're operating as a labor percentage, what you're operating as a profit for the month. And we put those in and we say, you know what, if you're operating at 35% labor, that's probably not too good. On a scale of 1 to 5, that's going to get a 2. And we just came up with this sort of little grid almost to weight these different factors. And then we put some other factors in there like your Q&A, right? Suppose your Q&A is at a 60. Well, that's probably not too good. So that's a little bit lower weighting. And maybe your mystery shopper stinks, and that's 65%. And then we take all these factors, and the theory behind it was you add up all the factors and you end up with a monthly score. And if we do that over time, it probably should shake out. The ones that are scoring the best are probably the healthiest financially and are probably being true to the brand with their mystery shops and their Q&As. And there's another category up there with social engagement, which means not how well you're dating or your relationship is with your wife, but or husband. But really, what's your presence online? You know, your Facebook, your likes, you know, your posts, those sort of stuff. Some of that is subjective, of course, but you know, we've been doing this now for 2 months, and it's interesting. We take a step back, the ones that are grading the highest are probably the ones that are doing the best within the franchise company in terms of promoting the brand, financially successful, and really adhering, you know, when they get shopped. And the ones that aren't doing well, it's like, yeah, you know what, that's the ones we're spending a lot of time on to try to improve their operations, you know, where our regionals are spending extra time in their stores, whether it's a cleanliness issue or customer service or training. So we're not just using it to judge the financial health of your individual store, but really where we can allocate resources and be a little more proactive as well. The other thing over time it's going to allow us to do is benchmark that much better, right? Once we get a lot of months of a lot of stores that have been open for a long period of time, the ranges become a lot tighter. We can tell people they should operate within. So we've been doing that. It seems to be working good so far. I wish it was a much more automated process. It's not yet. Although with 50 stores, it doesn't take that long to put this scorecard together, but with 150, it'll probably take a little more time. But it's an exercise we're working on. The other thing we've been able to do, I wanted to share with you some sales information today. And this is real data, not made up, of stores. I thought it was important to look at stores that have been open for more than 2 years. So believe it or not, we've had 12 stores that have been open since October of 2015 through September 30th, 2017. And I stripped out the Outer Banks stores. You know, they're an anomaly what they do. I stripped out some of the other stores that might open for just a couple months, like Hilton Head. Is Craig in here right now? No, Hilton Head and Avalon, New Jersey, that are just open for a very short period of time. Because I thought we got some new store owners in the room, and this kind of gives you trends that we see, as transparent as we can, on what the numbers would look like. So if you take those same 12 stores from fiscal year ending September 16 and compare them to fiscal year 17, they averaged $821,000 that first year. And then they came down to $770,000 year 2. Okay, so that's a 6% change. Of those 12 stores, believe it or not, 6 of them, just happens to be 6, saw same store sales increase and 6 had a decrease. So about half and half. The largest increase, we actually had a store that went up. Again, this is after their honeymoon period, so take that out. So went up 10% in sales from year 1 to year 2. But we also had a store year 1 to year 2 that went down 28%. So we've been spending a lot of time with that store. Well, why did that happen? You know, did we take our foot off the pedal, right? Did we stop paying attention to marketing every day? Did we take for granted, like Russ said, that you opened it, you built it, it will come? So there's varying factors, but I think I was somewhat, not that I was thrilled to see the 6% change, and we've seen level off since then. And I don't want to point out the specific stores, because some of them might be in here. But you can see the year 2, which I feel now they're in their kind of mature stage of who they are in the store, are still trending above, you know, we're telling people is the benchmark that they should be trying to run the business at. If you're running above that, that's fine and dandy, right? The business model wasn't built on $1 million of sales. And whoever's doing that, God bless them. And if you're doing less than 750, then we're here to help you get up to that benchmark. The other thing that we've really been able to hone in on, and this is really for new store owners that are in the room, but we have a handful that are new store owners, is really to focus on that honeymoon period. We heard a little bit about it earlier. So we saw on average that from week 1 to week 5, it was almost about a 15 to 20% drop in sales. From what you did, if you hit it out of the park that week 1. Now, not everybody hits it out of the ballpark. week one. But I bet if you talk to enough owners around here, they'd shake their head and say, wow, week one was really, really crazy, and I don't ever want to live it again. So there is a decrease, you know, after those first 4 to 5 weeks. And then you could maybe even expect another 10% drop. So it's not unusual to be 20 to 25% down from week one. And then you start to fit into what your new norm's going to be. The point there is a couple of things. One, don't get fooled by the honeymoon. Two, the faster you react when you see the business trending on your expense side of things, the better you'll be. If you think you got to staff it the same way you did in week 9 and you did in week 1, and you're getting 30 days to get your P&L, you're going to be shocked in your bank accounts. You're going to be scratching your head and say, where'd all my money go? So it's really, I'm just trying to give you some real life stories where we've seen owners, and again, I would ask each of the new owners here to talk to owners that have been around for a long time to help you manage through that honeymoon period, and our staff is obviously there for you. But to think if you, and I don't know if anyone in this room did it, but if you did $50,000 in week 1 and think that you're going to be doing that three months later, that's not the data we're seeing. I'm just putting it out there now. If you happen to do it, we'll all be at your house having champagne. That's awesome. So the point of it is, you need to be nimble. You need to adjust your business. And as we're getting more of this information, we're going to push it out and share it with any of the owners. If you have a specific sales discussion you want to have with me or the regionals or anybody else on our staff, you can either corner me here or feel free to call me at the office. I will share as much as I can with you. I'm never going to say Kelly's store just cranked out XYZ numbers for last week, and you know, whoever Baker's store is doing this. I will never get into that detail. I will protect. But if you want to say, how am I doing within the region, and you know, give me some store sales and need to talk through, you know, we're only here to provide service to you and to share that information so you can better run your operations. And we've done that. I've done it with other owners in the past. We'll continue to do that. So if there is any questions or you want to just be a sounding board, please feel free to reach out and we'll share that information. Any questions on it? Oh, you want to go into the season? Go ahead. You can do the season.
So this, and Russ, I mentioned this earlier too, it was surprising when we did a whole year of actually where the sales dropped per month, and showing here that September was the lowest month of the year. So everybody was down a bit here, and that's based on.
I think before you flip to that, Ian, it is a pretty, surprisingly, a pretty tight band of sales. I mean, we do have the outlier months, the highs and the lows, but you don't have the 15% down to 3%. There's not that roller coaster ride. Again, these are all non-seasonal stores, not dependent on tourism. You know, just your run-of-the-mill. You know, Carrie's got a couple stores in there. We got some Charlotte stores in there. We got the stores. Craig, we excluded your resort stores, but included some of your non-resort stores. So there's some Virginia Beach in there, but I don't think that's a tourism-dependent stores in Lansdowne or yeah. So I think we got a good mix in there of. We tried to pull out the noise from the chart, if you would say, to get you some normal percentages.
So best practices, things you really want to keep in mind as you're monitoring your stores, and make your deposits, get them in there. It's all about cash flow too. Monitor your bank account. If you don't have, see what you're doing, the flow of everything, the ins and the outs, it'll catch up with you. Again, enter AP invoices. Again, getting it in that bucket of when the true cost of it hit. When I say bucket, I mean in that month period, so you can do your analysis. And then you obviously have to pay your bills timely. Tracking your labor costs, that's probably the biggest thing on there. Keep that in mind. If you are opening and you have 4 people there and sales start dropping, send somebody home or don't book them. Your physical inventory, we talked about how important that is to make sure you get that done and adjusted every month, and then getting your financial statements done so you can see, you have a tool or something to look at so you can move forward with the best judgment.
Before you pass that, Aim, so in the room here, and Jennifer, your finance background, what other best practices do you think we should do? What do you do at Charlotte, not to single out, but you obviously have your act together financially down there. What are we missing? Do you log onto your bank accounts daily, most folks in the room here? Do you log on your personal accounts daily? I do. I mean, every day I log on to see has there been any crazy activity in my bank account. I mean, I do that in our business. I do that with our DDFC accounts every day. Kristen's on our bank statement, Amy is, I am. It's just a good business practice. Yes, Scott?
We enter inventory, instead of entering into inventory account, like the cost of sales at the end of the month.
You adjust it backwards.
The cost of sales. So what you can do, in the month, you can kind of look at it in the middle of the month. Won't be exact, because your inventory will go up and down at the end of the month. But it can give you kind of an idea where you're at during the month if you enter your inventory right to cost of sales.
Yeah.
And I don't think that's a generally accepted accounting principles to do that. But you can do it with QuickBooks, and you can get a snapshot in the middle of the month.
I think for our small businesses, probably the more prudent way to do it.
Yeah.
Can somebody expound on what he's saying, because I don't like waiting till I get my, be like, okay, how did we do for food?
So what Scott's saying is when you get your invoices in every month, there's two ways that you can do it. You can code it to the balance sheet and hold it as the balance sheet throughout the month, and then at the end of the month, when you do your count, you bring in the usage into your income statement, okay? The other way to do it is each month, every time you get an invoice, you code it right to cost of the sale, right? You code it down and say this much goes to food, this much goes to beverage. So every time you're entering that invoice, you can run a P&L on that day and see what your costs are, however your system can do it, week to date, month to date. And then at the end of the month, that number's probably overstated because you then haven't adjusted backwards for the inventory that's in your warehouse. So that may, yeah, hopefully you're not stockpiling inventory. Right? Right, we're not talking.
Yeah, that's what Cisco does. So we're coding it to the cost of goods sold, and they'll put it in there.
So I think that's what he's saying. If you code it right to your cost, then you can run a P&L, as long as you're entering the receipts in timely too, right? It'll give you a good feeling. Daily receipts, a good feeling if you're doing your own statements. I know Jennifer does them for their business. If you're outsourcing, it's a little more difficult. So they're actually able to get, I wouldn't call it a daily P&L, but they can run their P&L probably, if they want to do daily, without their labor being in there, and have a pretty good sense of where they're tracking for the month before they get that P&L, before it's truly finalized at the end of the month. When I hear some of our regionals say, oh, the place isn't making daily deposits, I just scratch my head. I'm like, who wouldn't make a daily deposit? I mean, there's got to be a really pressing reason if you're going to want to let your cash sit in your vault overnight and not deposit. Now, the credit cards have them automatically. Our business is still 65, 70% credit card. We haven't seen that shift too much, but I mean, golly, get your money in the bank. Don't let it sit around in your store. Too many bad things can happen with it, so that should be happening on a daily basis. Any other best practices from the people that are operating that we're missing that help you run your business? Aim, I know you're all the way over there. Anything on your end? Randy, Cal? You guys have been running the business for a couple of years now. Anything from the finance end?
I mean, what I throw out, we make it different from some people. We do as much as we can ourselves, and then we pass it to our bookkeeper. So that's why we're waiting till the 25th. It's probably on us to get more done, but in that process, we know so much. We've learned so much, I guess. Like we're able to see the data, we work with the data, and we're entering all of our bills, our receipts,
So what they're giving you is no surprise.
Yeah, there's no surprise. I mean, which it's a balance because we're giving up our time to do that. At some point, we may get more to the bookkeeper, but he's really just putting in payroll and tying it up with the vote for us. But yeah, it helps to actually physically do a lot of it ourselves. Really good for us to do it. As much as we can.
Any other questions right now on that? Comments?
And then again, some other financial parts, we have the sales tax, which you're either doing monthly, quarterly, you have mostly, everyone has state, some have local, county as well. Value Tech, I've had a lot of questions on that, so I'm gonna go over that quickly. That's the gift card program. So on your POS session summary report, you have your ins and your outs, your people buying the cards or people redeeming them. That's netted together as one of your numbers on that sheet, and you'll book it and they'll take it from your bank the next month. So on September's POS statement, you'll have the net of it. So when you're booking your revenue journal entry, the bank won't actually pull or give you that money back for that time, and it's usually around the 25th. The value type fees, like the finance fees, pull your bank about the 10th of the month, so that's usually between $5 and $25. And then now we're getting more into these integration of other things, such as Uber Eats, the third-party things. So we have some colleges that are getting involved with using their swipe cards for the college kids. So more and more that's coming in, integrating with our POS system. So lots of different fun stuff. Again, hopefully everything will start to streamline and process automatically. That's the goal. But that's all she said.